Basic accounting concepts. The necessary assumptions or conditions upon which accounting is based are known as accounting concepts. Mr. A decided to start a business by the name A Enterprises with cash 3 lakh rupees, land worth 10 lakh rupees, machinery worth 2 lakh rupees, a total of 15 lakh rupees. Thus, Mr. A has introduced 15 lakh rupees in all. This is the concept of business entity. This amount of 15 lakh rupees is liability of A Enterprises and is shown in the books of accounts under the header Capital. Three months down the line, Mr. A needed money for his personal use. He withdrew 1 lakh rupees from the company. As the funds withdrawn were for his personal use, A Enterprises reduces the amount from the total payable to him. So, the firm needs to pay Mr. A an amount of 14 lakh rupees. This is the concept of business entity. Owner and the firm are two distinct entities by themselves. Any money, whether in cash or in kind, introduced in the firm by the owner is the liability of the firm. Any withdrawals by the owner for his personal use is drawings and reduces the liability of the firm. Money measurement concept. The firm expanded its business over a period of a few years. It acquired additional land for business and purchased additional machinery for increasing the production level. It also appointed a new manager to handle the day-to-day working of the firm. How does the firm account for all these? Additional machinery, land, expenses and revenues. Aha! It is very simple. The second accounting concept, money measurement concept, clears all the doubts. Only those transactions which can be expressed in terms of money are to be accounted for. Value 10 lakh rupees. Value 1 lakh rupees. Value cannot be ascertained in monetary terms. Going concern concept. Going concern concept assumes that business concern will continue for a fairly long period. Let me explain. A Enterprises bought machinery worth 5 lakh rupees for the firm. It is expected to last for a period of 10 years. In that case, an amount of 50,000 rupees can be charged from the profit and loss account each year. Accounting period concept. We are already aware that every transaction which can be expressed in monetary terms and related to the firm needs to be accounted for. On the basis of these, financial statements of a firm are prepared. These statements are of use to various users, external as well as internal, such as management, shareholders, creditors, and debtors at regular intervals. The financial statements are, therefore, prepared at regular intervals, normally after a period of 1 year, so that timely information is made available to the users. The span of time at the end of which the financial statements of an enterprise are prepared is known as accounting period. For example, 1st April 2009 to 31st March 2010 is known as accounting period for the year 2009-2010. There are a few exceptions when interim financial statements need to be prepared. For example, at the time of retirement of a partner. Cost concept. Mr. A acquires machinery worth 1 lakh rupees for the firm. 10,000 rupees was spent on its transportation to the firm. After 3 months, due to shortage of such machinery, it is now available in the market for 1.5 lakh rupees. At which price would the cost of machinery be recorded in the books of accounts? According to the cost concept, all records are historical in nature. They have to be recorded at the purchase price plus its acquisition cost. That is 1 lakh rupees plus 10,000 rupees, which is equal to 1,10,000 rupees. Dual aspect concept. Mr. A of A Enterprises purchases machinery worth 30,000 rupees and makes payment by cash for the same. Now, there are two things happening simultaneously. First, machinery has moved into the firm. Second, cash has moved out of the firm. A Enterprises makes a sale of 50,000 rupees and receives payment by check. Now, there are two things happening simultaneously. First, machinery has moved out of the firm. Second, the bank balance has increased. Thus, every transaction is recorded at a minimum of 2 places in the books of accounts. This is the core of double entry system of accounting. Revenue recognition concept. Let us understand this concept with an example. A enterprises can generate income or revenue in two ways. First, when there is inflow of cash on account of sale of goods or services. Second, by use of other resources of the firm, for example, interest, royalty or dividend. Revenue is assumed to be realized when a legal right to receive it arises. In this case, when goods have been sold or a service has been rendered, revenue is considered to be generated and not when money for the same is received. Revenue in the form of rent, commission or interest are recognized on time basis. Thus, rent from firm's warehouse, resources for the month of March 2005 will be taken in the financial year 2004 to 2005, though actually received in April 2005. Similarly, interest for April 2005 received in March 2005 will still be considered in the accounting year 2005-2006. Full disclosure concept. The Indian Companies Act of 1956 has specified the format for the preparation of profit and loss account and balance sheet. This is necessary because the financial information is of use to different groups like management, investors, lenders, suppliers. All material and relevant facts concerning financial performance of the firm must be fully and completely disclosed. Consistency concept. While comparing financial statements over a period of time or with other enterprises, it is necessary that they have to be consistent to arrive at any conclusion. Conservatism concept. It is necessary to have a very conscious and conservative approach while ascertaining income of the firm, so that profits are not overstated. Let us take a hypothetical example. With just 3 entries in the trial balance, let us presume that no transactions take place during the year, which means the firm has neither made any profit nor any loss. Now, at the end of the year, the market price of the stock is 70,000 rupees, whereas the cost price for the same is 50,000 rupees. If the firm takes a higher value for accounting, then it is seen that even without a single transaction, the company owes Mr. A a sum of 1 lakh rupees instead of the original 80,000 rupees. If profits are overstated, it will lead to distribution of dividend out of capital or reduction in capital of the firm. The concept of conservatism requires that profits should not be recorded until realized But all losses, even those which may have a remote possibility, are to be provided for in the books of accounts. If the market value of the goods purchased has fallen down, the stock will be shown at cost price in the books. But if the market value has gone up, the gain is not to be recorded until the stock is sold. This is called conservatism approach. Materiality concept. The concept of materiality requires that accounting should focus on material facts. Efforts should not be wasted in recording and presenting facts which are immaterial in the determination of income. Objectivity concept. Financial statements are of use to many users, namely creditors, management, lenders, investors. Hence, accounting should be free from bias of accountants and others. Thus, every transaction should be supported by a verifiable document named voucher. To summarize, the basic accounting concepts are referred to as the fundamental ideas or basic assumptions underlying the theory and practice of financial accounting and are broad working rules of accounting activities.